Hello, everyone. This is Russ Condy again, and it's about 2 minutes after. We still have a number of people joining in, but we're going to go ahead and get started. That's just the nature of doing these webinars. I want to thank everyone for joining us today. I think this will be a pretty interesting topic. Uh, we did a little piece of this at the CMA conference in San Antonio with a couple other GMs on the panel, Jim Butler from Gray Oaks and Michael Wheeler from Cherokee. And if anyone was in that session, it was a pretty packed room. 400 to 450 people. And we've taken this a little bit further. We're really taking this executive dashboard KPI view further because it is critically important. And I think it was the sign that this is a pretty topic of high level of interest. When we opened the webinar and we sent out the notice, we basically hit our capacity in about the first 2 hours. So we actually have another session going on in May. So if you have anyone who wanted to participate in this one, wasn't able to, you can point them to our website and they can register for the one in May, and it'll be basically the same session as this one. Just a little bit of housekeeping. If you want to ask a question, the easiest way to do that is to use the chat window. You should see a little chat box on your GoToMeeting control box somewhere on your screen. So just enter that chat, and I've got Terry Finan of Club Benchmarking also on with us today, and she's going to take a look at questions as they come in, and she'll either hit me with those as we get them, or we'll cover them at the end depending on what they are. Okay, looking at today's topic, it's the topic is called Key Questions for Club Leaders: Introduction to the Executive Dashboard. I do want to just note that this will be, in addition to doing another one in May, like all of our Fast Fact webinars, this will be archived, and it's on our website at clubbenchmarking.com/videos. So this webinar and all the previous ones that we've done on different topics are over there. So if you haven't seen some of those, you might want to take a look over there. It's a pretty good repository for information. It's an interesting topic we're talking about today. The industry has never really had a common view of itself. It's certainly always shared data, but it's never had what we call a common dashboard. So, today's goals for the session are, we're going to just take a little quick look at what is an industry dashboard. What does it mean? Why should an industry have common measures? We're calling it a dashboard, but in effect, it's a collection of common KPIs or key performance indicators in a consistent, standardized view. Why is that a good thing? Why is it valuable? What is it and why it's valuable? We're going to get into, ultimately what this is about, and the challenge of the industry is, do clubs, either club executives or club board members, are they asking the right questions? And then by definition, are they in search of the right answers? Or are they not asking any questions, or are they asking the wrong questions, things around food costs and all that sort of stuff. So we'll take a look at that, and along with the dashboard, we've literally come up with what are the key questions that correlate to these key performance indicators. We're actually going to take a look at the report. I mean, we do try to keep these to a half hour's time, as we sort of advertise them. So we'll go to, probably 40 minutes with questions. But we are going to take a look at the dashboard reports. We're not going to dissect every number. We're going to do those in different webinars, but I think there's an important concept to hit before we get into the real numbers. I always like to start out in most of the webinars we do with just some of you have seen this, I'm sure, but a little bit of a framing slide, because I think it helps get everybody on the same page as to the sort of the nature, or maybe the foundation of some of the challenges we face in this industry. So, as I've talked about in the past, the club industry, private club industry, is a $20 billion industry. It's a pretty good sized industry. And it's extremely fragmented, which means there's lots and lots of players. So the largest single player is about $95 million. And so what you've got is thousands and thousands of small clubs that are, at the median about $6.5 million of revenue. That's very different than most industries. Most industries are very much a pyramid, where you've got the very, few very large clubs at the top, and then they get, considerably smaller down at the base. This is a very, very flat industry where there's lots and lots of small players in that $20 billion industry. Within that industry, if we just look at basically CMAA clubs, about 3,000 clubs, you've got on average about 11 people per board. That's 33,000 people walking around the country today, basically wearing the hat of governor for a private club. And that's a pretty challenging ratio to deal with when you're a club manager or a controller, or maybe you're a board member trying to get the board to become more effective. And what makes it worse is every year a third of those people turn over. So there's a new 11,000 people, and every 3 years is a whole brand new 33,000 people. So that's obviously a challenging environment. So the more you can hone in on a common language and common set of measures, you can imagine the effect that that can have in this high transition governance model, where you need to get people up to speed very quickly on what matters and get them off of their agenda driven stuff that they often come into the boardroom with. So it's that issue of ineffective governance. Not everywhere, not every club. There are good boards out there for sure, but by and large, it is a problem for the industry. And so we're going to talk. This ultimately is about standardization within the industry and standardization of measures. Essentially what we're calling a common language. And most businesses and most industries have a common language. So if you think about, if you've ever poked around, financial websites, or you're into investing or the stock market or anything like that, you know that terms like EBITDA, or earnings before interest, taxes, depreciation, and amortization, is a common industry term. P to E, price to earnings ratio for a publicly traded stock, is a common term. Gross margin is one of the most common business terms of all. And if you go into something like Yahoo Finance, you find that there are very common business terms that people can have, completely coherent conversations with each other about not only different businesses, but different businesses across different industries. And those still have coherence, even though there might be, those businesses in and of themselves are different. The club industry is different, right? It doesn't have that common language. And you can see it when you have, two board members, two GMs, two controllers bump into each other and they talk about, how are things going at the club? And it's a very anecdotal sort of opinion-driven discussion. It's, we're losing members, or we just got a bunch of members, or we don't have enough capital, or it's too much of this or too much of that. And it's much like the problem in the boardroom, because there's no common language to talk about things like gross margin, to talk about things like, operating result. And so there's no reason that this industry can't have a common language and a common dashboard. In fact, if you go into something like Yahoo Finance, these measures are the same. The values are different, but the measures are the same. It doesn't matter if you're looking at, shoe manufacturing companies, software companies, or car companies, right? Everybody uses these same standard measures to gauge the performance of a company, and most importantly, as we'll talk about in a minute, to predict the performance of a company. Because ultimately, that's what all this is about. It's not, while we use past data, it's not to look at what you did. It's to use that information to predict and to manage, how you're going to go forward. So, we take the most basic of all business questions, right? You look at gross margin. What's your gross margin? Well, we know what is gross margin. Gross margin is you take your revenue, you have a cost of goods sold, and that leaves you subtract your cost of goods sold, and that leaves you with a gross profit, and that percentage of gross profit over revenue is your gross margin. And so we know, in the software industry, gross margins are typically, they're high. They're 80%, because the cost of goods sold, the physical medium, is very, very inexpensive. So it's a very high gross margin. And then they use that gross margin to pay for all their fixed operating expenses, R&D and development and marketing and G&A and all those sort of things. You go to the other side of a different industry, the nail business, make, roofing nails and such. It's a commodity. There's very low margin in the industry. They run on a 15% margin, because all their costs are physically in the cost of goods sold. It's the actual product themselves and the labor associated with that product. And there's very little left over, because there really aren't many fixed expenses like there is in something like the software industry. And so, the question is, what is the gross margin in the club industry? We now know, and we're going to talk about that. But the industry has run without the most basic, sort of business concept around things like gross margin, and we're going to get into other indicators. But certainly, no, there are very few, I would say, board members sitting around, of those 33,000, that even within once in the year, ask the question out loud, what is the gross margin of our club? So we're going to talk about that a little bit more amongst a whole bunch of other things, but that just sets up the, a little bit of the notion of the common language. And then, you sort of have this, we've been big on positioning the business model of the industry. What is the business model of a private club? And this executive dashboard and these key performance indicators fall right in line with understanding and measuring your business model. And I think there's been a little bit of a tendency in the industry to say, well, we're not-for-profit businesses, so we don't have a business model. We don't, we're nonprofits. And so, that's a misnomer. And I think this is a great way to look at it. Nonprofit is a tax status. It's not a business model. Any business where there's revenue coming in, there's expenses going out, and there's some service or product being delivered has a business model. In fact, I like this notion of what is the definition of a business model? The rationale of how an organization creates, delivers, and captures value. Now, they are non-for-profit, so they're not capturing value in terms of trying to generate profit, unless you're a for-profit club. But clearly, a club is an organization that creates and delivers value to its members. And so there is absolutely a business model around how that's done. And in fact, from our perspective, understanding your business model is not really optional. If you don't understand your business model, how is it that you have confidence in, predictability of, or really a complete grasp of how you're creating and delivering value to your customers, which is your members? So the business model is the mode by which you create and foster member satisfaction. So you have to understand your business model, and you have to look at the indicators. I don't want to sound overly dramatic, but it's highly beneficial to understand your business model and understand the indicators which bring predictability to that business model, right? Because members like predictability in their club, right? They want to come in and have the experience that they expect, and that tends to be a repetitive experience. So, the more predictable that your business model is, the more predictable the service delivery to your membership can be as well. So, we look at a common industry dashboard, and it really is the way we framed it. It's what's the common language of questions and the common language of answers that create that predictability in the club industry. So we just, rhetorically ask, what if every club measured the same things, right? Could now when two GMs or two board members or two controllers come together and have a discussion and say, and they how's your club doing? Oh, well, our gross margin fell by 5 points, and that had this impact on the club, or our capital generation is weak, and because it's at this percentage, and this will all make more sense in a few minutes. But if you had those measures, could you overcome that cult of personality that can often exist in the boardroom, where it's the table pounder that is ruling the day or ruling the meeting, because there's nothing there to help combat that, to bring the conversation back where it should be. Would it improve club governance? Would it help all clubs, especially challenge clubs? I mean, the clubs that are doing great, you still want to know where you are, because if you're doing great, you want to know where are your measures when you're doing great, so that you can watch them and keep them there. If you're doing poorly, you want to know where are those measures and where should they be to help us get out of this difficult situation. So it's a help for all clubs, regardless of where you are. And ultimately, this is something from Gartner, which is a research company. I happen to think is a pretty solid company in terms of business management and research. It's really about what this goal is identifying and developing an industry standard or industry standard measures that are predictive of performance, right? Because if you're not using this information to help you make better decisions going forward, then what's the point? Then it's information for the sake of information. So what we're all trying to do is create predictability in our clubs, because clubs want to exist forever. If you're a 100-year-old club, you want to live another 100 years. If you're a 5-year-old club, well, you want to get to 25 years and beyond. So every club wants to live forever, and the more predictability you can put into your business model, the more likely you're not going to hit these road bumps and stumbles that are going to potentially put that legacy at risk. So I do want to move ahead, because I do want to keep an eye on the time. But ultimately, what's the impact on an industry? On this industry, we've talked a lot about there is tremendous commonality in the business model across, in private clubs. Clubs are different size, they're in different places. Many of you have heard us give the available cash view and looked at seen our maps where you can, there is no differentiation of the business model based on size of club or location of club. If the more people that know that, the more that's background information for them to, get beyond well, we're different because we're in California, or we're different because we're a $45 million club. Imagine if a GM or controller went from club to club, left the club and went to a new club. Just imagine if the same actual measures and indicators were used in one club to the next. How much would that change the transition and the ability to hit the ground running and understand the club that you're going to? Now you go to one club and they measure, these 10 different things, and the club you came from measured those 30 other things. And obviously, even more important probably is when a new board or new president or new treasurer comes in and they throw a whole different set of measures that you're going to look at. Imagine the consistency in the dialogue if, as board members turned over, you didn't change what you looked at. You looked at the same things. I'm talking at the high level. Issues may come up, you have to look at other things, but I mean at the high level. So ultimately, it's about having the relatively low number of indicators to look at and stewarding those members to give you predictability into club health and sustainability, right? That's the whole idea behind this thing. And so I like this. I don't know if anybody has seen this before. Obviously, it's a quote from Albert Einstein, and I'll read it in case you can't read it on the screen. But he's saying, if I had an hour to solve a problem and my life depended on it, I would use the first 55 minutes determining the proper questions to ask. How brilliant is that, right? So, and now let's reflect on our experiences maybe in the boardroom, where are they really spending their time asking questions, trying to frame what's going on, even if there is a problem or not? Or are they spending their time, with the race to the answer? So I think that's brilliant. And I think this, by the way, personally, I feel that this applies into everything in life. The more you ask questions of anybody you run into, strangers, whoever it is, whether it's around business or personal, you enrich yourself individually by asking questions. And a club enriches itself by frankly having an inquisitive board, and a board that spends time asking questions. So, it's a little tongue in cheek, but I sort of morphed this to, if I had one board meeting, to solve a problem and my club depended on it, I would use the first 55 minutes determining the proper questions to ask. The same thing applies. And what we're going to go to in a minute here is, as the starting place, what do we think are those set of questions that frame the club, and what are the KPIs that are associated with those questions? And of course, when you have that kind of approach, you really find out, do we actually have a problem that needs solving or not? Again, I tend to generalize here because there's a blanket issue in the industry we're trying to solve, but boards tend to start from the belief that, well, it's our club that's screwed up, right? We're the ones that are screwed up. Everyone else does it great. So, that's their starting place, and that's the wrong starting place. The right starting place is to be asking the questions to understand, what does our model look like? Is it healthy? Are we on the right track? What are the questions we should be asking? All that sort of stuff. So, it gets to the bookends of governance, if you will, which is, is it a group of people who strive to identify and ask key questions versus a group of people who compete to answer questions without considering relevance, right? We've all seen the body dynamics when there's a discussion and someone can't wait to give their answer as to, A, what the problem is, and B, what the answer to the problem is. Well, if you're in a great governance mode, there's a lot more time spent here than there is down here. So that's all a little bit of framing to get into this actual dashboard. And I know you can't read this. I'm just, we're going to get into this individual sections. But what this is showing you, and there's a page on our website now, which I'll show the URL in a minute, which has this dashboard set of questions and the indicators that correlate to it. But these are the 14 indicators that right now, we've seen certainly through the data that these KPIs clearly correlate to sustainability of a club, sustainability and health of a club. And then what we actually did was we said, well, if that's true, if these indicators really tie into club health, what are the questions those indicators are actually answering? So we did a little backwards, but we went back and said, let's develop those questions. So they're in 5 groupings, and this gets into the dashboard itself. There are some around what we're calling operating finance, capital generation, operations, membership, and debt. Right? Those are the 5 groupings of the questions and the indicators. And the first one is really just operating revenue, and it's not really a KPI. It's more of a profiling question, so that if you did want to, understand where your size is relative to the industry. So we're not going to spend any time on that, but clearly a rational question. And when we came up with these questions, we tried to put them in the sense of how it might be asked in the boardroom, how they should be asked. So, the question is, how much money is available to cover our fixed expenses? And basically what the answer to that question is, it's your gross profit, right? So if you've got revenue coming in, you've got some cost of goods sold, and then you've got a pile of money left over, and that pile is what you use to pay for your fixed expenses, which is your course maintenance, your G&A, your buildings operations and maintenance. Anyone that's looked at the available cash model knows where those recognizes that pie of where those fixed expenses go. But clearly knowing how much you generate is key, right? It's not just about revenue, because we know $1 of dues revenue is certainly not the same as $1 of food and beverage revenue. So ultimately, what's the pile of money you get? And it's what we have been calling available cash, but it's really gross profit. The next question is, does our revenue, like you would ask in a business, does our revenue mix produce adequate margin, I should say. Again, F&B versus dues as the scenario. And what that really is you're asking, what's the gross margin? Because if you're a club that has, a very, very weak dues engine, and you think that, doing lots of banquets is going to beef up your dues engine, it's not going to work that way, because the mix, the margin of $1 of dues versus the margin on a banquet are 2 completely different animals. And so ultimately, this is what is the gross margin in the club industry? And we know it's right around 60%. That's where clubs run, with a 60% gross margin. And some clubs have lower and some clubs have higher. And we'll look in a minute, there's a direct correlation to the gross margin and the net operating result of the club. So we'll look at that. Since we know that dues is the major component of a club's gross margin, right? That's where all your cash comes from. We do specifically say, is our dues engine, is the dues component of our revenue suitable? And we use the ratio of what's your dues to operating revenue. The industry runs at 50%. If you're a $10 million club and you're right down the middle of the industry, your dues will be right about $5 million. And you can see the correlations to operational break even for the clubs that have a weak dues engine versus clubs that have, a high dues engine. That their dues is maybe 55 or 56% of their revenue. So that's the question. That's the indicator that correlates to that. Obviously, an ultimate question: do we produce enough money to fund operations, right? Or, do operations draw money or produce money for capital, right? If you don't produce enough to fund operations, what do? You steal your capital income. If you produce more than you needed for operations, you throw it over to the capital side, and that ends up in the capital bucket. So, that's the rational business question, and the KPI is, what's our operating bottom line, right? We use it as net available cash, and we're going to look at that one specifically as well. If we go to the next section, capital generation, how much, these again in the board, high-level strategic questions. How much capital income did we produce? Well, you add in club benchmarking, we add up your sources of capital income and you end up with a number. That's a good indicator, but it's not the most important indicator, because again, we just talked about, if you had an operational deficit, you stole your capital. So the really important number is, what's our net available capital? So how much capital is available after adjusting for an operating gain or loss? That's a strategic question. If you had $1 million of capital income, but you had a $300,000 operating loss, you end up with a net available capital of $700,000, not $1 million. So that's a key question for boards and clubs to ask. And then the final capital key question, do we produce sufficient capital? You ultimately can't answer that unless you do something like a capital reserve study. But the way we measure that is, we look at your net available capital, and then we simply divide it by your operating revenue. We know that right at the middle of the industry, clubs have a available capital ratio of 11%. So what does that mean? It means if you're a $10 million club, that means your net available capital number, so after operations, was about $1.1 million. Now, it doesn't say that's enough or not, but it says you're right in the middle of the industry. So it's a reasonable indicator that you're okay. If your available capital ratio is 5%, you're on the lower side of the industry, it's very, very clear that you're going to be capital starved. So I've come to believe actually that this ratio, of everything we've done in club benchmarking, I actually think it's the most important ratio that we've come up with, because it's net. It's what I call a net, right? It's net of operations, net of capital income. How much money did we generate to reinvest back into this club, right? Whether it's maintenance capital or whether it's aspirational capital to build new things that the members will enjoy. Very, very important. Operationally, we look at are we staffed at a level that balances financial results and member services? That's one that's thrown around all the time, right? We have too much people, too many people. We pay too much, too many staff. People are standing around doing nothing. It's a critical ratio. It's the easiest one in the world to measure. It's the payroll to revenue ratio. We know that the industry runs at 54%, right down the middle. And it varies, but it doesn't vary widely. We know that as you get to 60%, it almost becomes impossible to break even. So it's a critical ratio. So it's a critical question, right? What are the key questions? It's a critical question, and it's a critical answer. The next operational KPI on the dashboard is what's the financial impact of food and beverage on the club? And we've done whole webinars on this one alone, but it's the net food and beverage to available cash ratio. So how much of my gross profit did I need to subsidize food and beverage? If you used 4% of your gross profit, you're right down the middle of the industry. And that's why using a dollar number doesn't mean anything. A $200,000 loss, a $500,000 loss, that doesn't mean anything by itself. Now, if you say how much of my gross profit did I use to subsidize that, it means a lot, because that gross profit is what you use to pay for all your other fixed expenses. So that puts it in context, and it gets people away from, talking about, what's the cost of food last month versus this month. That's not an executive level, question that correlates to the predictability of the club's performance. Membership, just quickly, we talk about the dues engine a lot. And so the question, hey, very simply, are dues rates and member count optimally balanced to produce adequate dues revenue? That's a question, strategic question, every boardroom should be asking themselves. And if the answer is yes, great. But you want the two things you look at are what are our full member equivalents and what's our full member dues. Now, Club A might want to have the culture of we have only 250 members and they're each paying a high dues. Club B might have a culture and strategy that says we want people to pay only $4,000 a year, but we're going to have 1,500 members because we have the facilities to support that. So there's not a right or wrong. It's just that are we balanced such that ultimately that dues revenue ratio, right, 50% at the median, is giving us the output that we need. And then, of course, a question that's critical to any membership-based organization is what's our level of member attrition, and we just calculate full member turnover as part of that. And then finally, when you get to debt as the last category of the executive dashboard, we look at it from two perspectives, from a full member equivalent perspective and then on a club level perspective. So the two key questions, right? Let's put the Einstein wig on. Two key questions. What is the burden of debt on our membership? And what do we look at? We look at debt per full member equivalent. We know in the industry, at the median, the debt per full member equivalent is just under $5,000. And you'll see some clubs with a debt per full member equivalent is $20,000. It's a pretty big burden, to say, does our membership have the capacity to handle that, whether we're going to assess them, whether we're going to take a long time, whatever it's going to be. So that's the one way we look at it. And the other is basically, again, the key business question, how leveraged is the club? And to that, we simply look at the debt to operating revenue ratio. The industry runs at about 40%. If you're a $10 million club and you were right in the middle of the industry, you would have about $4 million of debt. Now, that gets us some strategy as well. is some clubs just fundamentally say, we don't like debt and we're not going to use debt. That's fine. But you start to get up for other clubs that start to get up to that 80, 90, 100, 115% ratio or more. There are clubs that are 150% ratio. That's a highly leveraged position. And if you don't know that, if you don't know that your business model is leveraged that highly with debt, you're not going to have predictability because you're going to end up feeling stress, and that's going to start to tear at the seams of your club's business model. So what I want to do just quickly is I'm actually going to jump in, and I know on the webinar we have a whole bunch of club benchmarking members, and then we have some non-members as well, which is great. But I just want to take a second and show the members there are 2 reports that if you haven't done it yet, you should go in and run. One is we have a Word version of the executive dashboard report, and in fact it lets you, it gives you in one very simple tabular format every one of those KPIs that we just went through, and my value, and then the relative percentile values of the peer set that you filtered for. So, you start to get boards thinking this way, what's our revenue? What was our gross profit and gross margin? And what was our operating bottom line? What was our capital generation ratios? These are really important questions that clubs need to be able to ask and answer. And so you want to ask it in a standardized way. More importantly, you need to be able to answer it in a standardized way, because if you do, every club has their own accounting process, and if it's not a standardized answer that you can measure that answer against the industry like we've done here, then you have less and less confidence in your actual answer. And then there's also a PowerPoint version of this, so you can go through, and it's called Executive Dashboard Report. You'll see 2 of them, and you can go through, and instead of in tabular format, it gives it to you in kind of the normal club benchmarking curve. So this is the gross margin curve as an example, and we can see here's where my gross margin is, and here's where the peer sets are. So I think it would be great for the members, if you haven't already done so, please go in and run that. Use both versions. We've had a lot of our members say, hey, I brought both those into the board, and I can't believe the discussion we ended up having. It was a business discussion. It was not an emotional discussion. And then for non-members, you can go in and go on to clubbenchmarking.com/dashboard, and you can actually pull down a sample report. Obviously, it won't have your data in it as a measure, but it's not a bad place to start if you're not sure if you want to jump on board yet. Just to look at a couple examples, I've taken the operating bottom line of the club we're going to look at, and then we're going to look at that net capital ratio that I said was, I think, the most important one. But if you look at net available cash, and we know that about 40% of the industry, 45% of the industry is still not achieving a break-even bottom line. About 55% is having a break-even or throwing off some surplus operationally. And when you look at the indicators, it's completely clear and predictable. So the folks that are down here that are burning cash operationally, right, here's the median value. So we know gross margin in the industry is median at 60%. These clubs for these clubs, in this quartile, the median is 56%. They have lower gross margin, they have lower dues ratio, and look at this, they have a higher payroll ratio. So their cash is less liquid, and their expenses are higher relative to labor, which is the highest expense in the club, obviously. So I could look at without knowing anything else about the club, I can look at these indicators, if this were a particular club, and say, I'm pretty darn sure that this club is not supporting itself operationally. I'm going to guess it's burning cash because I know it's got a low gross margin, it's got a weak dues engine, and it's got a higher than typical labor ratio. Now, obviously, right in the middle, plus or minus, you tend to be around these plus or minus or break even. And if you look at the clubs that have a higher than typical operational surplus, not a surprise. You can see their gross margin is higher than typical. Dues ratio is about the same. So this extra margin is a little bit coming from dues, but the rest is coming from somewhere else. Maybe they do more outings. You'd have to obviously dig into it a little bit. And their payroll ratio is actually lower than the median. Now, obviously, payroll ratio is one of those. That's why when we asked the key question, we said, is it optimal for the affordability, the financial results, and the member service expectation that you're looking to achieve? So there is that facet of it. But interestingly, this is where the clubs that are for-profit clubs, they tend to live around this payroll ratio or even a little bit lower. So it's not a surprise that you're seeing this performance up here. But again, it's very clear, right? If all I knew about this club were seeing these indicators, I would say this is a club that's throwing off cash. I wouldn't even have to see their bottom line. I would know it. So it would creates predictability. So just imagine when you're going through your planning and you're forward thinking and you say, if I can all of a sudden place place values on these few, not a lot. We're talking a dozen key indicators. This is where our club should be, and that gives me a very high, predictability of achieving, at least financial operational break even. That's a huge deal, right? So then we go to the next chart, which is this available capital ratio. And obviously, your net operating result feeds into this because if you burn cash operationally, you're right off the bat, you're sucking out of your capital flow. So, you want to treat them separately in some respects, but clearly the operational result has an impact on your capital generation. And so it's the same thing here, right? Here's where I talked about the industry is at 11%. So $10 million club. If you were the middle club, you're producing 1.1 million of available capital after operations. And obviously, these are the clubs down here. These are clubs in big, big, big trouble because below this line says, even if you stole every penny of your capital income, you still did not achieve break even operationally. You really need to know if you're here and you need to make changes in a hurry. And luckily there are in a whole lot of clubs here. But, frankly, if you're anywhere in this zone, you want to know it. You want to know exactly anywhere you are, because even if you're up here, it's good to know that you've got the capital inflows that are going to enable you to keep reinvesting in the club. That's the bottom line. Keep reinvesting in the club. So, clubs that are down in this lower quartile, they burn money operationally and they have pretty anemic capital income. The clubs in the median, tend to be that are at this 11% range, tend to have, somewhat of a surplus and this level of capital income. And obviously, the clubs that are outperforming, they're throwing more money off of operations, and they've got a higher capital income. It's the bigger, and the reason for that is, and I don't have all the the data on this chart, but the bigger clubs are the healthiest in the industry right now, and they're throwing off the larger amounts of available capital. So the bigger clubs right now in the industry have a higher available capital ratio than the smaller clubs do. But you have to know where you are, because if you stay too long in a capital starved mode, down in the single digits, it's going to start to show on your club. And if you're down in this 25th percentile or below, you need to know it and take action immediately. Those are strategic dialogues in the club. So I'm going to be wrapping up here to try to finish up. I know I'm running a little bit late. I apologize for that. This guy is back. He seems to show up in every webinar, and I don't know who he is, but he's the guy that tends to catch our slings and arrows. But this is about changing the dialogue. Are you going to ask the right questions and satisfy those questions with the right answers, or are you going to support these discussions around, we spend too much on labor? What do these people do? Hey, in my business, we measure X, Y, and Z. I already know what needs fixing when I come in the room. We should make money on F&B. All this stuff that folks that have been in the industry have heard forever. And, there's the cliched big reg X across it. So that's the dialogue that tends to happen in the industry. If you don't spend time, like Albert said, asking the right questions, and then by asking the right questions, you go in search of the right answers. And I would just say, versus a very, frankly, business-oriented view of what are the indicators that correlate to predictability of performance. That's the whole idea. We don't like surprises in clubs, right? We don't like operational assessments because we didn't have enough money. We want predictability. And I can tell you without fail, and everyone I'm sure will nod their head, talking about the variation in food costs from last month to this month is not predictive of overall club performance. What that is a waste of time. And so, I don't mean to be so forceful, but this stuff works. These measures work and this data works. and framing it and using it in a way that gets the board where they should be and gets the discussions, it's critical. This executive dashboard report, I liken it to it's a full body scan. It's like a full body scan MRI, right? So it assesses the overall health of the organization. Now, you still want underneath it within CB, obviously you've got the individual departments and lots of other department level indicators. You still want that from a diagnostic perspective because you might want to peer into something for some reason, or you might have an indicator that says something's not right. My labor ratio is high. Let me go through the department labor ratios and see if I can pop out where that one is and then look at that. So you need both. But, what you don't want to do is get mired in diagnostic discussion when you haven't had the full body scan discussion. That's the key. That's what I guess what I'm trying to get across ultimately. And it's taken us a long time to get to this point. We've been rolling around the industry data for 5 years almost, and we're pretty happy that we think this is really going to be a game changer. So creating this industry dashboard that works club to club and works obviously clearly survives board changes, we think can have a pretty significant impact on the industry. So I do apologize, I went a little bit over, but I also want to give a chance to ask and answer some questions. So what I'm going to do is I don't see Terry here, but I can look at the questions myself. Let's see. Oh, so define full member equivalent. Okay, yeah, full member equivalent is pretty important. It normalizes your member counts, so it's the total dues revenue divided by what a full member pays. And I'm actually glad you asked that question because what I forgot to show you was in this Word dashboard report, underneath the table of values, there's actually specific definitions and calculation behind every single KPI. So you're not just handing the board member or the GM, for that matter, a table full of numbers. There's a very specific set of definitions around each one of those, so they can say, well, what is capital generation ratio? Well, you can look and see exactly what it is. So thank you for asking that question. But it's a way of normalizing, so that if you had, let's say, 5 socials that paid 20% of what a full member pays, each 5 socials in effect makes up one full member equivalent. And we use that a lot. Let's see. Does it take into account how can you create this on a monthly basis? So right now, in club benchmarking, the platform can do monthly. We only have annual turned on. So the first place to start is annual, and make sure you run and understand that. But we may be getting close to moving into a quarterly world as well. I'm not sure about monthly. That gets pretty granular. The other question is, can this report be filtered? Yes, this is the same as any other report, so you can filter it any way you want. I'm struggling a little bit without Terry here, but another question is, I guess it's tongue in cheek. Why did this take so long? It's a good question. I think everybody, this industry has survived under the notion of we're not businesses, we're clubs, and we're all different, right? You can't compare. I'm special. I'm unique. I'm not like any other club. So there was this group think of there was no commonality and common framework that could be or should be measured. And so I think we're just frankly the first ones that had a ton of data to look at, and we kind of step back and roll around in it and say, why not? Why is this industry any different? And it turns out this industry is not any different. There is a common language and set of ratios that can be used. So.
Russ, I am here. There was,
Oh, okay.
and I'll apologize to the group, there was some confusion around the session login information, so apologies to anybody that had to fight their way in, but thank you for your persistence. We have a question from Chris, which is, does available cash ratio take debt service into account, and if not, is there a measure that does?
We would treat debt service coming out of the capital flow. So it would show up in your net capital generation number. Basically, we consider capital to be used either for investment or debt reduction. So it wouldn't show up in the available cash ratio, because that we consider that an operational set of flows, but it would show up in your capital flows as we've talked about them.
Okay, and I
And
think a variation on the same question is there a metric for cash reserve or capital fund, and I
there is actually, it's one of the we don't have it as a KPI, but because we're looking at what did you generate, in the prior year in this active year. But if you look inside club benchmarking under the balance sheet tab, there is both a cash reserve metric and a capital fund metric, because people treat those separately. We say, do you have a capital fund and how much is in it? And then we also ask you, how much, what's in your, what does the club have for cash and cash equivalents? Great. All right. Well, I appreciate it. I apologize for going over, but this is a pretty important topic, and again, it will be up in the archives, and keep your eyes open for more webinars around this topic, because we're going to dig into the ratio and values more, and you're going to hear more about this because this is pretty important stuff, we think. So I appreciate it, and we'll talk to you all soon.